speakers are Bill Kelly, who's the President and CEO of CAIA Association, and Elena Manola-Bonthond, who is the Chief Investment Officer for the Pension Fund at CERN. And with that, I'm going to turn everything over to Bill and Elena. Thank you.
Thank you, Todd, and thank you to CFA Boston for this partnership, and happy to be sitting in this third seat. And I think my colleague John Bowman is going to be wrapping it up with number 4 in person. So I think that'll be a good capstone for what sounds like it's been a good event, and we appreciate the partnership. So maybe just a couple of remarks before I turn to Elena. So I do a lot of this moderation myself, and people ask me oftentimes, what's the best way to prep? And one of my pieces of advice is, before you go on air, look at the FT, look at the Economist, look at the Wall Street Journal. Make sure there's nothing going on in the news cycle, so you're going to look like a fool. And I've on cue in this morning's FT, and they don't like alts. There's a headline. This is in Robin Wigginsworth's column, Alphaville. The headline is "Private Debt Out of Control." So I don't know if I necessarily ascribe to that principle, but we have what was once an asset class that really came out of the GFC, and we'll talk about some of the formative reasons as to why it is where it is. But we went from just about zero to about $1.4 trillion of assets. By some counts, is still about $0.5 trillion of dry powder in that 1.4. But Preqin, which does a lot of research in this space, estimates we're going to see a doubling by 2027. So on its way to approaching $3 trillion. And some would argue that number seems quite low. But certainly, we've been in a rising risk environment. We've had 11 hikes since the first quarter of last year. And the risks are there. The opportunities there too. You want to make sure you're being compensated for the risks taken. And if I think about the varieties, and we're going to cover some of this with Elena today, if you want to be high up in the capital stack, you can get direct lending. If you want to be subordinated, there's mezzanine, second lien, this preferred equity. And then on the higher, maybe on the far end, higher risk, maybe higher reward, distressed and special sits. And then there's real estate and venture, and a lot tucked in there. But rates have climbed dramatically just in the last 16 to 18 months, but interest coverage ratios have gone down too. So this is not for the faint of heart. So due diligence is at the center of this. And I can think of nobody better than my board colleague, friend, and fellow member, Elena Manola-Bonthond, to join me here today. So Elena, welcome.
Thank you very much, Bill. Thank you for having me, CFA Society Boston. Thank you.
So I think maybe before we get into opportunities and risks, Elena, maybe looking at it through the lens of the CERN pension plan, because you have obligations to meet. And if rates were high enough, you could take the rest of your career off and just cruise on meeting a return assumption through the bond market, but it's never that simple. So maybe just a quick thumbnail of the CERN plan, and then we can get into how you access the debt markets.
Yes, sure. So we are a defined benefit pension fund. We manage 4.6 billion in Swiss francs, it's approximately the same as dollar, in assets. We have a quite important allocation to alternatives, different type of alternatives, from real estate direct to hedge funds, private equity, venture, private debt to infrastructure. And if I look together at the private equity and private debt, and if I count also the capital that is committed but not yet called, that would be 13% of allocation of our total allocation, with 3/4 to private equity today and 1/4 to private credit. We have been investing in private credit since I believe 2015. That is when we started investing in private credit, more in a senior part, if you like. And we are continuing. We also have, quite a diversified portfolio, but I guess we're going to discuss later about this in more detail.
Okay, and maybe just one last piece to maybe complete this story. In your role as an allocator, and this is different for endowments and foundations, different for CERN, different for a public pension plan, but the liability side of the balance sheet does come into play. So are your beneficiaries, are they the employees of CERN?
Yes. So we are, as I said, defined benefit. We have today 4,000 members, 3,600 beneficiaries. Our funding ratio is 70%. only. Our discount rate is 3.85%, but this is in Swiss francs. You must not forget, I guess the most of the participants here listening to us are denominated in dollar. We are denominated in Swiss francs, and the rates are not quite the same. You know, policy rate in Switzerland is 1.75%. It's quite different than what you see in the US. So yes, and what is also interesting about us that most of our investments are in foreign currency also, because you know Swiss market is quite small.
So when rates were at or near zero or negative, which was true in Germany as an example in 2021, it seems like so long ago, but it really wasn't. It made any allocation to fixed income, I would assume, quite unattractive. But even in Swiss francs, a policy rate of 3.85 makes the attractiveness of the debt markets, I assume, much more in play. And that sounds like if you said you're 13% in the private markets, a quarter in private debt, so 4 or 5%, is that about right?
Yeah, a bit lower, yeah.
Okay. So is that, and you said you started in 2015, is that, are you at a comfortable rate, or do you see yourself legging further into that?
But it's, you know, it takes time to build a portfolio, and we are not dogmatic about the target allocations, but we tend not to try to reach a target in a small, in a short period of time. It takes time, probably take a decade and a half to reach kind of stable, mature portfolio in private debt. And when we started, and the rates were completely, we were in a different world, if I may say. You know, the private credit was offering still in this time attractive premia, you know, compared to what you could see compared to the risk-free rate, basically, right? And it made sense for us from this perspective. It still makes sense for us. Obviously, today, when yields are much higher, and the whole demand-supply dynamics of the private debts has even evolved in a way that is favorable to private debt, even more favorable than it was before. You know, we know that in the past, banks, you know, stepped out because of the regulations, etc. Now, this problem is even more emphasized because, you know, broadly syndicated loan market was basically shut down to a large extent, and the private credit becomes, you know, kind of favorite financing avenue for private equities, for sponsored companies.
And I think that's an important point, Elena, that I mentioned at the top of my remarks, that the evolution of this market is an evolution, not a revolution. And Messrs. Dodd and Frank in the US really shut the banks out of this business. Maybe they'll come back with rates this high, but it seems like regulation makes this exceedingly unattractive for them. And it seems like the private markets have come in and filled that gap. So I think there's no reason to fear it because it's got the word private or alternative in front of it. It's really the new home for lending. And maybe starting with some of the opportunities that you see in your seat, Elena, and certainly we saw the 60-40 got scorched in the US in 2022. We saw a couple of bank failures, and these are mostly due to not a poor lending criteria, but duration mismatches. And I think that's really what hurt investors. And as best I understand, and curious to get your investment thesis for this, if I think about the private markets, duration is really not so much on the table because you've got an adjustable rate and may adjust on a semi-regular basis. You've got access to reasonably good collateral. So there's a lot of things that I think make the private markets much more attractive than you can get in the public markets, not the least of which is there's probably much less inventory that's interesting.
No, absolutely. And if I look at the private markets, both on the, you know, equity and debt side, you know, if you look at the equity, I know this is not the topic today, but obviously the whole mass of LBOs becomes more challenging and the valuations are vulnerable. Fine. M&A activities is subdued. There is nonetheless a lot of dry powder still there to be deployed. And probably at some point with a better visibility on the rates, there will be some pent up on an M&A, given that also valuation could find itself at a very attractive level. Now, if you look at the private credit, as you said, Bill, it's a different type of market and different instruments that are not really comparable to what you see in public, and yields today are higher. And this is basically due to two things. The base rates, this is one element, definitely one important factor. And the second is in this supply demand that, some borrowers that would actually go to broadly syndicated loan markets are now turning to the private credit. So this is, I would say, good news to private credit. But more or less, I would say that independently of other opportunities that borrowers can find, there are some intrinsic good properties of attractiveness of private credit, is that you have confidentiality, you have certainty of execution. I think this is extremely important. You're not dealing with a big number of lenders. You can concentrate your dialogue, have confidentiality, and have this certainty of execution. And then if you put yourself in the perspective of the allocator, you will see that for the new deals today, conditions and terms and documentation is much more solid than it was, a couple of years ago in our previous vintages, if you like. And this is all very positive. So that would be all the, I would say, favorable elements on the side of private credit today. Now, there are risks also, and you mentioned risk. And there is no doubt that, with higher rates, there is a pressure on the companies. There is a pressure on the liquidity. There are also, EBITDA margins may be eroding because of the cost inflation. So all this together is obviously putting pressure, and interest coverages are deteriorating. And this is where risk, is present. And we see this, in some funds that were invested couple of years ago. We see that there is a lot of, amendment type of activities. We see that some cash payments are deferred in the form of PIK payments. And so we do see stress, and I think, the opportunity is there, but it's extremely important to partner with managers who are skilled and who can work on the capital solutions, and who can even do workouts if it's needed.
Well, you mentioned private equity. I know, as you said, Elena, it was covered in another session, but I think it's hard to not talk about private equity in the context of private debt, because there is a bit of a fulcrum effect, because you're exposed to both. And as you said a moment ago, if you're invested, either debt or equity holder, in a stress environment, the business model is under stress, and your cost of capital has gone up on the debt side. And oftentimes that's offset by less investment in CapEx, less investment in human resource. So do you think about this exposure to private equity, to private debt, vis-a-vis your private equity book as well? And are you in the same side of the capital stack, equity and debt, in some of these private equity companies?
I would say that the two allocations in a portfolio of institutional investors are complementary, if you like. Are complementary because you're investing for a long term, and I don't think one should be really tactical, when you invest or do a macro calls on private assets. When you invest in private assets, in private equity, not because you want to take the advantage of, financial engineering. You invest because you believe that the governance that companies can have in the private markets is more conducive to better growth and better value creation. So of course there are challenges today, and again, the returns are going to be probably lower in next couple of years. Yes, fine, but this does not change investment thesis. Now on the private debt, again, the thesis is different. The two can be complementary. Some problems for private equity may be, some opportunities in private debt, but this can change as the time goes.
And as you think about private debt, then do you think about a debt fund differently than debt to support a private equity investment? Are they one and the same in your mind?
But I would say there is there is certainly an overlap there, right? So most of our investments in private debt would be to sponsored companies, so the private equity backed company. Direct in non-sponsored deals, we are not heavily invested there because there are additional risks that not many managers, we are not comfortable with many managers actually being able to manage that risk today.
And maybe just to stay on this for one more second. So with some of these sponsored deals, I'm seeing as that debt matures, a lot of these GPs are being asked to kick in more equity at refinance time. And you mentioned financial engineering, and that has some impact on returns at a point where I assume that you have target allocations, you're hoping to get cash back. And then we have these NAV loans that have been talked about a bit too. So maybe your view on on having to kick in more equity upon refinance for some of these deals, and then also on NAV loans.
No, absolutely. We see that. We see also, a lot of peak toggle mechanism being used. We see some sponsors that are actually, pairing growth in order to preserve EBITDA. We see a lot of, activities from the sponsor side on the portfolio management of the existing, portfolio management. NAV loans. We are not today, invested in any NAV loan fund. This is something that we are looking at. I don't know. I'm a bit skeptical, to be honest. There, looks very attractive on the surface. But for an investor, if you're an investor in private equity, then you invest in a NAV loan, it looks to me, very unable, like you're taking money from your left pocket, putting it in your right pocket somehow. So I have certain concerns that I'm not super enthusiastic about this.
Well, hopefully, I've seen some articles that I think, given where we are in the market cycle, I think it's helped improve some of the transparency between GP and LP. And I know the work that you do on the board of SBAI, the Standard Board of Alternative Investment, continues to try to shine a bright light on that. And we do have conflicts. The GP has shareholders and partners to worry about, but they have clients too. And we've got to make sure that we do as good a job as possible to make sure that if there are conflicts, we recognize them as opposed to just trying to engineer our way around. So I'm trying to keep the ledger a little bit balanced, Elena. I want to maybe go back to some of the opportunities as well, and we can go back and forth clearly. But I'm thinking about the difference between direct lending versus high yield. You're getting, I would assume, all things being equal, a better return in direct lending, maybe a better credit. You're higher up in the capital stack. You've got better collateral. And there could be a couple of basis point difference between the two. And I saw somebody recently I don't know, one of the CEOs did an article on this, and they talked about the arbitrage between high yield and direct lending, which was kind of an interesting play. So what are your views about accessing direct lending versus high yield? And do you see an arbitrage in play where you can perhaps get a better risk-adjusted return?
I see on the high yield, high yield has one attractive feature, and that is liquidity. So from that, I don't know. So what is the price that you give to this liquidity? That is an open question. And liquidity means opportunity to adjust your portfolio as the things involved, and private credit, again, the opportunity set is very attractive today. It is difficult to have an outlook on the rates, for, say, these funds are long-term funds, and today there is a certain opportunity sets. If the course of rates changes, the private credit may become less attractive compared to other asset class, and then you are in an illiquid asset class and you can't really maneuver your portfolio. So I would say we do have high yield and the private credit in the portfolio, and I would not say that one excludes the other. The liquidity is different, the purpose is different in the portfolio. I would not replace private credit by high yield or high yield by private credit. There are two asset classes that have different liquidity matrices, and they are complementary.
No, I think good points. And maybe just a follow-up on that. After this denominator effect, which I think is out of the news cycle, it may still haunt you, I don't know. But that was primarily on the private equity side, where people going into the secondary market and having to sell out of their private markets to top back up the equity markets after 2022. How developed is the secondary market in private debt? Is that a place where you see opportunity or where you travel?
I think there should be opportunities, not that we came across, interesting, not that we came across, but I think there will definitely be opportunities there. Looking at our portfolios and some portfolio management issues that some of our managers face, I'm sure that there will be good secondary opportunities there. Same from private equity. It is interesting because we received the calls people asking us if we are selling. We don't receive a lot of calls of people offering to buy, secondaries. So I think this will come. I'm not sure the secondary market is at the peak today.
Okay.
But this is obviously something to look at.
Yeah, no, so worth watching. So you mentioned before, Elena, we could touch upon due diligence, but manager selection in the private markets is, I would say, table stakes. And unless you have a skill to find those very best performing GPs over long periods of time, you're going to end up with the median results, which are undifferentiated. So with that as sort of a given, and maybe we'll come back to what you do around due diligence. But if you think about this market, do you have a different view on the private debt in the Eurozone, or specifically in Switzerland or parts of Asia versus North America? Do you look at them as one and the same, or just some of them offer unique opportunities?
I would say our due diligence process, we are mainly concentrated on Europe and North America. So our due diligence process is the same, on European or North American funds. Now the landscape is a bit different. You find in the US maybe more the proportion of borrowers with a more aggressive leverage structure is higher than you will find in Europe. But I would say the due diligence process is same. There are today more opportunities. The private credit market is more developed in US than it's in Europe, but it's also starting in Europe. We were, just recently looking at opportunities in management buyout here in Europe. This was more in the mezzanine space. So there are interesting opportunities. I think, given the risks that are present today, you really want to partner with managers that have a lead, that are not just participating, but it is extremely important that manager has the lead. So not just participating amongst the others. It is extremely important that manager has experience in workouts. And this is not the problem is that we are out, the last time the workouts were relevant is long time ago. So you don't find many managers that kept this activity in-house, that invested in that activities that was not necessarily the most productive over the last decade. So partnering with these managers that have this experience, that have still these teams that are able to do the workouts and take the keys if needed. It's not that you wish this happens, but if it happens, you need to have, that capability, that capacity in-house. And, then the next question, would be, again, if you go to private markets, it is also who get this alpha, right? That we want private markets to bring to us. So you want managers that are able to source the deals and avoid defaults, and you want the managers that are able to do, work out if the situation is such that that is needed.
And do you find, if you think about Europe versus North America, it oftentimes alpha, and maybe always, is found in less traveled circles. And I don't know if North America is a more crowded market versus parts of Europe in the SME space. Maybe there's a great opportunity for alpha. And when I'm saying alpha, I guess maybe that's more of a private equity phenomena, but certainly a good credit with a higher rate is alpha yielding as well. So do you see perhaps more opportunity for alpha one market versus the other?
Absolutely, I would say very likely so in Europe, that you have a kind of more inefficient space in a sense. So there is an opportunity. Now, it is on the other hand, it's true that you have more competition in the US probably, and the competition generates excellence in general. So these are two sides of the balance. So probably opportunity set, interesting in Europe, less competition. Now, given that there is less competition, is this necessarily good? I don't know.
And you and I were together in the Middle East not too long ago, and India is very active in this space. You mentioned North America and Europe. Are you going further afield around geography, or is that just beyond your scope of?
No, we stay in geographies where we are, where we used to invest in the past. I'm not saying that there are no interesting opportunities elsewhere. For sure there are. But for us, we are a relatively small pension fund, and we try to stay focused on the geographies, not managing too many risks at the same time.
Yeah, no, it makes great sense. And then in terms of knowing what you know, I think that's a Warren Buffettism. Thinking about the types of companies you're lending to, and I think in this current market, having businesses that maybe are less cyclical, and I think about maybe healthcare, and maybe sometimes you don't have direct control over that because there's a fund raise and then that's invested subsequently. But are there either industry-specific funds or industries that you find much more attractive to be lending into?
We are in principle sector agnostic, but we will try to find the managers that focus more on B2B kind of, in B2B space. And although you can find good opportunities in the sectors that are perceived as very risky, like today in real estate. So we are not trying to find a sector specialized managers. We are rather agnostic, but we like that managers are focusing all on the sectors where they have an edge, or more B2B. And again, as you said, Bill, you don't always have to have control. Yeah. You don't always have control.
And venture debt, are you doing anything there? I think the venture space has dried up to a large degree. But again, if you're thinking about accessing opportunities both on the debt and equity side, is that an asset class that has any appeal? It's probably pretty small.
It's a very small. It's very, I would say, small. We had one investment there that we made long time ago. But it is small. It is has a certain specific risk. It's not our favorite. We will not overweight venture debt in our if you like, allocation, for sure. Okay. More straightforward, like senior, senior or distressed. So we have been investing in distressed since a number of years now. Again, it is, you can't really say, now maybe there will be stress, now I will invest in distress. It will be probably too late. So we have a kind of constant allocation to distressed in our portfolio. There I think there could be a lot of opportunities for several reasons, as we said, because of the pressure of the debt service, but also because of the weak documentation that exists, a lot of weak documentation. I'm not talking about, violence kind of actions, but it is very likely that some stressed managers are going to exploit those opportunities in weak documentation.
And if you think about stress distressed, how do you think about that from a CIO standpoint? Is that more of a capital appreciation play? More so
definitely. Yeah, no, definitely. That would be really return-seeking strategies. So there you are clearly in return-seeking.
And I would assume, given where we are you seeing more distressed funds in the marketplace? Because I saw Buffett, as an example, has just a load of dry powder, and he seems to have been the savior to so many over the course of his career. And being a liquidity provider in this cycle might be an awesome spot to be. Are you seeing more funds?
Yes, we are. We see also, hedge funds around that space, definitely. And maybe some type of trigger funds that could be, launched at a certain point in time. I think there are going to be a lot of opportunities in that space. But again, it's very difficult to time the market. So we tend to keep kind of constant exposure to stressed.
Yeah, and maybe a related point to that, Elena, I think these are Goldman Sachs numbers, and I think I saw this maybe in the FT, but it came out of a report on this concept of the wall of maturity coming up. And I think as I said, it was not that many years ago where we had negative rates. So these rates have really popped in a very short period of time. So most of the debt on the balance sheet of private and public companies is at a very, very low rate. But the Goldman numbers, and they're somewhat telling, and I forget when this was, I assume maybe just a few months ago. So I'm guessing maybe in the second half of 2023, 230 billion maturing, 2024, 790 billion, 2025, 1.1 billion, and it was even slightly higher in 2026. So it's not only the size and the scale of these numbers, but the uptick in underlying rates. And how do you think about that as you access to space? And maybe we've already touched upon this a little bit, but I wanted to get your views in light of this wall of maturity. And I've even seen some people indicate, and maybe these are the big private debt GPs that say it's overblown, and there's maybe something to that, but they might be talking their own book too.
Yeah, I think, that was less of a worry last year, because GPs were saying, oh, it's not yet there, it's not now, it will be in 2-3 years, it will be more of a problem, but it is coming. And I think there is where the opportunities and stressed and distressed are going to come up clearly.
And I think there was a side reference. It might have been in the same report, or I read it in conjunction with that 50% of the public companies do not make a profit. So that's problematic in the public space. I would like to think in the private space, where you've got a concentrated shareholder base, they can do things on a dime. They don't have to worry about public disclosures. It's probably not as pronounced, but I think that this cycle of the market is going to put a lot of strain on even the most positive of business models. So I think it's something that from an underwriting and deal standpoint, I think certainly you pay attention to, but if those funds were raised 2 or 3 quarters ago or a year or so ago, understanding how they were being invested is going to be critically important.
No, absolutely. And you mentioned this, Bill, at the beginning of the session, that you see private credit everywhere a little bit, and there is a lot of publicity on private credit, especially in conference circuits, private debt, private credit. So this is also a little bit, can be a sign, of maybe too much of exuberance in these asset classes from the investors.
Yeah. Okay. So I wanted to turn to ESG generally and maybe climate specifically, Elena. And this is obviously, I think Europe is much more focused on this than US. And I remember being in Switzerland on a business trip decades ago, and I went to throw something out, and I think there were 15 different cans to choose from, and I was overwhelmed as to where to throw my trash. So I think you folks have been very focused on this. But if you think about a green initiative, patient capital, I think, is a better answer, because it's not a high frequency type trading when you're just trading in and out independent of underlying approaches to ESG. But do you think about, I assume you have ESG or climate in your investment policy statement. How do you think about incorporating that or not when you're investing on the private credit side? Because I think you're probably delegating to some degree to the GP as well.
Yes, so we don't have a kind of specific ESG bucket, if you like, in the portfolio. We have a high level ESG policy that looks in the whole portfolio and looks at the carbon footprints and alignment, etc. And then our actions on the ESG or on climate more specifically can be expressed in different manners. For instance, investing in innovation around energy efficiency, energy sources, etc., investing in sustainable infrastructure. It can be expressed also through private credit in the infrastructure space. So that it's kind of a cross-portfolio team, but it's not a standalone team. The return comes, the investment has to make sense from the return perspective, and then overall at the level of the portfolio, we are going to look at the ESG.
Okay.
And then when it comes to other elements of ESG that are more on S, there we will, when we do our due diligence, we will see how the GP intends to address this point, or when we come to G, well, that is also addressed during the due diligence.
And I'm going to show my ignorance as an American here, but I think there is EU regulation, which I assume maybe Switzerland is subject to, where these GPs are categorized into these articles, and I think Article 9 might
Absolutely,
be.
Yes. There are a number of articles. We are not restricting ourselves to different, to saying, oh, this manager have been in that or that article. As a CERN Pension Fund, we also are international organization. We are not necessarily Swiss or European fund, but we are not restricting ourselves to managers that fall in a certain box.
Okay, all right, terrific. So we're about 40 minutes in, and I'm not sure if Todd mentioned it or not, but maybe we're going to turn to some Q&A. So for the folks in the audience, you can certainly drop some questions into the box for Elena, and I'd love to get your thoughts too. So Elena, there is one question here where the questioners asked you to elaborate a little bit more on these various reasons why you prefer a partner with lead experience. And I think this is concept of club deals that might be more prevalent in Europe versus the US, and maybe I have that wrong, but maybe some further thoughts.
Yeah, you want to partner definitely with GPs that have a lead and not be only participating investors, because when in a situation of crisis or liquidity stress, you want to be able to negotiate and also to dictate the terms, and this is where it's important to be a lead, to have this negotiating power. And
so, yes, so like so many things in life, when the sun is shining, everything is great. But I think you made this point a couple of times throughout that things are going to break, and that's the reality, and that's part of the risk you're taking on. And it's probably no more complicated than that. When that breaks, you want to make sure that your GP's got a lead seat at the table and not at the children's table.
Absolutely. This is, this is extremely important.
So a follow-on question. I think this gets back to the FT Alphaville article where they use the actual word of systemic risk here. Are you concerned about systemic risk in the private credit space? And you and I won't name the conference. It seems like you and I travel in circles. It's because you're such a great friend and member and very involved. We were in Boston together just a couple of weeks ago. And it seemed like every single panel is private credit, direct lending, and it goes on and on. So it's on the tops of everybody's minds. Do you worry about any kind of contagion here? As we said a moment ago, we're going to have some breakage, clearly, but are you worried about a more widespread conflagration than that?
You could imagine, and again, I have not studied this in more, in depth, but when you we know that there is a certain stress in private equity, okay? Because for some managers that were maybe more focused on, mathematics of the LBO rather than the creation of the value, etc. If you start, now with NAV loans, and you get in some kind of, I would say strange configuration, at least to me, when you have a private equity that is, having liquidity issues, and then you do NAV loans. And I'm wondering what kind of, explosive this mechanics could create at the end. Again, I have not studied this in a detail, but this could be, in my view, source of risk if there is no liquidity, and when we try to compensate it with yet another, engineering at the end. I don't know how this could unfold, but I have not studied it in more detail.
Well, maybe a sort of a follow-up and semi-related question, and this is maybe outside of the wheelhouse of CERN, but you see talked a lot about people in this industry, Elena. Democratization is alive and well, and as the story goes, giving the average person on the street greater access to risk premium beyond the public markets, they should have that because their pension plan, the one served them did, and that plan doesn't exist anymore, and they've got to now do it on their own. But if you think about the many challenges we've talked about for the private credit markets, and you're a very sophisticated investor, even through a fund, what are your views on democratized access to the private markets? And we've seen this with, well, maybe it was more B REIT than B credit, Blackstone, but I think sometimes investors fall in love with the yield and they don't realize that they're really underwriting a credit and they're deferring that responsibility. So what are your views on maybe more broadly democratization, but democratization, you should think about it in the credit market?
Yeah, it's interesting because a couple of years ago, there was also talks about democratization of private equity. I think it is, these are the asset classes that are complex. And as you mentioned, there is a risk of saying, oh, this is a great yield, and yield is actually good, but there are some risk behind. And, we are a team here. Some of experienced people in the team. We are partnering with other experienced companies that help us with operational due diligence. We spend a lot of time looking at this, studying this, talking to the managers, etc. So to get a comfort in investing in these asset classes, I cannot imagine how individual investor with less of these tools at disposal could actually be comfortable in investing in these, asset classes and have a fair representation of the risk that this presents. It is the risks that we are talking about are multi-layered, and although you can maybe write this down in a document, it takes some experience to understand really what are the different ways this risk can materialize. So I am not necessarily fan of these democratizations, and it could be a very good intention, and it could be also a way to get the liquidity.
Yeah, and I think that's the most important point. And you talked about the difference between direct lending and high yield, and you can get the liquidity in high yield. You can maybe get greater diversification and a higher
Exactly.
coupon in direct lending. But if you're going to stick that in an interval fund that's opening its door every quarter, I think that's a recipe for potential disaster. Even if the underlying manager and the underlying investments are very good, if they have to be selling them at the wrong point in time and taking losses, it's just I just don't know if the investor understands long-termism, and I think that's got to be kind of table stakes before we get them involved. So there are two other things here that we can cover, and then if there's no further questions, we can, well, this will probably get us close to the top of the hour. But we just briefly touched on covenants, Elena, and we used to have covenant light quite a bit when people were giving money away, and it was a lever to invest in the private equity side. How have covenants evolved, and how do you get comfortable with covenants? Are they less light than they once were, or is there more transparency?
No, absolutely. I think, terms, including covenants, are really moving in the good direction for us, for sure. As you said, Bill, a couple of years ago, this was neglected, obviously. And not many managers cared really about this. But the situation is different today. And, as we mentioned before, this could now give be source of a lot of, violence in this creditor market, I think, because some of these covenants are too light. And it is not difficult to imagine that some managers are trying to take advantage of this, or some opportunistic investors. But the things are now moving in a good direction. Things are moving in a good direction because of this, demand, supply, and balance that we have, because the broadly syndicated loan market is shut down, so there are more bargaining costs on the side of private credit, and I think this is contributing to this situation.
And this maybe somewhat of a related question that just came in about changes in due diligence, which I think maybe ties into to covenants. That's part of good due diligence. And how has that progressed? And we still have dry powder in play, clearly, that's looking to be deployed. As I said before, you may see a different number, Elena, but if this industry's $1.5 trillion, I've seen numbers of 400 to 500 billion of that is still dry powder. But maybe your evolution of due diligence, which maybe goes a little bit of hand in glove with covenants.
To be honest, on our side, the due diligence template, we were just reviewing our investment guidelines just this week on the private credit, and our due diligence template actually, has not changed on our side. But I would suspect that the due diligence template of managers, which changed a lot. This is what I think happens, and I hope it happens more and more now. And we want to partner with the managers that understand that today their due diligence is fundamental for us. So one of our elements in our due diligence is understanding how they do their due diligence, how they source the companies, how they evaluate the risk, how they position themselves, where they go in the capital structures, and how they, measure, evaluate risk, stress test, etc.
And it's been,
yeah.
Sorry, go ahead. Sorry.
No, these discussions with the managers on, asking them how they do their due diligence is probably longer today than it was a couple of years ago.
And if I think about due diligence, there's both initial due diligence, then ongoing due diligence, and maybe one way an allocator tries to solve for that is through the LPAC, perhaps, and you can take the other side of that. But as we talked about before, the levels of transparency and trying to improve that, and maybe trying to balance the scales. Have the LPACs gotten a little bit more toothy in terms of their ability to be heard and influence, or figurehead is too strong a word, but have you seen that evolve in terms of their importance, presence, and ability to affect change?
I suspect this is something that is going to be more and more the case of LPACs being more vocal there, for sure. And more activities related to this also with different industry members such as SBA and similar organizations.
Okay, so Elena, we could just got about 9 minutes left, and we'll have to fill the whole hour. But maybe I'll just turn it over to you for maybe closing observations on this panel. And I think your bio, it was in the program, so anybody here and anybody listening to the recording can see it. But I do want to underscore that you're a very thoughtful investor, but also globally curious. And in addition to being on the CAIA's board, the board of SBAI, the Bank of International Settlement, AIF Global. So you have the ability to talk to a lot of people around the world, and I think it makes you a better investor. So I think maybe some of your observations, and not only your day job, but a composite of a lot of this thinking. But maybe if you think about closing remarks, maybe the overall global state of affairs and the outlook in the investment world, either specifically through the private debt lens or more global.
I think we live through very interesting times with some challenges and risks, but extremely interesting times. And this is where I think you learn the most. It's now. It's much more now. I learn more every day in 2023 and 2022 than I learned in months a couple of years ago. So from this standpoint, I think we are privileged and fortunate to be in a role of allocating capital in these challenging times. And now private credit, yes, it's a fashionable asset class today. That does not mean it should be dismissed. It does not mean it should be embraced like 100% fall in love with yield, etc. There are risks behind, but it is extremely interesting. I would say it is extremely interesting to have the opportunity to allocate in this time in this asset class.
Well, CERN is fortunate to have you, and I would say to the listeners out there, I think what's made you so successful is you are so curious and getting outside of your comfort zone. And I've said this, Elena, about you publicly before, and I'll repeat it here. You're one of the few that have come into this industry as a scientist. You started out as a scientist and then moved on to the investment side. And I think you were both before your time and now in an interesting place as we see generative AI and machine learning and all this data that's measured in zettabytes coming into play. And, and I think, as you say, the old Chinese proverb, may you live in interesting times, is a harbinger for not peaceful times. And we are in interesting times with long geopolitical risk, more so than we want to be. But I think the smart allocator can look at all this disruption and find opportunity. So thank you for all that you do, and
thank you. Thank you for having me. Thank you very much.
My pleasure. So Todd, did you want to close us out?
Sure thing. I want to thank everyone for joining today, and a very special thank you to Bill and Elena for presenting to us today.